In this video, we're going to compare the price to earnings ratio versus the price to free cash flow ratio. Both of these ratios are used for stock valuation. With the PE ratio, they use accrual accounting. What this simply means is they show profits that are left over after the expenses with this accounting. With the PE ratio, the profits, so the revenue and expenses, they can be recorded before cash is actually received. An example of this is if a company has a contract that they're going to make a certain amount of money, they can include this in the revenue before the cash is actually received. With the price to free cash flow ratio, they simply use free cash flow. They do not use accrual accounting. They use free cash flow in their ratio, not profits. The PE ratio uses profits, and with the price to free cash flow, they use the free cash flow. So, with this being said, the revenue and expenses are only recorded when cash is received or when cash is actually paid. So that's a big difference between the two. The PA ratio uses profits in the calculation. The price to free cash flow ratio uses cash or free cash flow in its ratio. Some say that you can go bankrupt from positive profits, but you can't go bankrupt with positive free cash flow. You can artificially inflate profits, and this affects the PE ratio using accrual accounting. You can't do this with price to free cash flow ratio. The free cash flow is what it is. It is best to look at both of these ratios for the stock that you're trying to do a valuation on and compare it to its peers.